let's look at cash flows that are mostly considered under investment appraisal evaluation. Now, earlier on, I've been mentioning about cash flows. But cash flows are not the same as accounting profit. Now, I told you that cash flows are the dollar amount or any currency, your own home currency, that is expected to be received, or that is expected. And it is the dollar amount of cost that is to be also incurred. So it involves two main things. It involves benefits to be received and costs to be expended. But accounting profit comes out of accounting principles. So when you look at accounting profit, you realize that even for sales revenue, sales or revenue, any item sold is recorded as sold not when money is received but when the item is sold. So let's take, for instance, this is a product. This is a product of the company. Okay. Now this product of the company, immediately it is sold to a customer. It is recorded as what? It's recorded as sold, and revenue is what? Recognized. Revenue is recognized. But actual money is received after some time, especially when there is credit sales. So in the income statement, when they draw in the income statement, there are in the current account side, you realize that there are debtors or receivables. Now these receivables represent monies that have not been paid by people we've sold items to. And so for accounting purpose, you realize that income is recognized not when money is received but when an item is sold. So the accounting profit in a financial statement represents monies that are being expected or money that we have received over some time, with some monies still being owed to us by our customers. So accounting profits are not the same as cash flows, because accounting profit is regulated by accounting standards or accounting principles, but cash flows represent real monies that we will be receiving. Therefore, what are the cash flows considered in investment appraisal? Cash flows considered in investment appraisal. Now basically there are two types of cash flows that are considered in investment appraisal. The first one is called capital cash flows. And the next one is operating cash flows. Now, what are capital cash flows? You realize that I stated here these cash flows are benefits as well as costs. So they will involve costs and they will involve expected benefits. The same thing applies here. They will involve costs and they also involve expected benefits. So the examples I'm going to give involves benefits as well as costs. The first one under capital cash flows is the initial investment. the initial investment. This is also called initial outlay. Initial outlay, or it is also called capital expenditure. Okay, so this cash flows, the first one is a cost, which is initial outlay or capital expenditure. It is the same thing. Now, what is this kind of cost? It is the initial amount that companies put in any investment. It is the investment that the company makes in a project with anticipation of getting returns from the project. The next one is additional, sorry, the next one is additional or midway investments. An example is working capital. Example is working capital investments and upgrades and upgrades and upgrades expenditure. So when you look at any investment project, realize that midway through the investment there are certain additional costs that must be incurred to keep the project running, and these costs come in two forms. The first one is working capital investments and upgrade expenditure. So if there is any cost, or if there is, say, even in the course of the project there might be a software that the company is using for its operation, upgrading such a software comes as a consequence of the operations of the business going on or the project going on. This upgrade expenditure becomes relevant and is classified under capital cash flows. Working capital investments are monies that must be kept in the business in order to ensure that the business is running every day. Without this working capital, the money or the project cannot run smoothly. And when you look at working capital, it's basically current assets minus current liabilities. What are current assets? We have stock, we have cash, we have receivables, we have bank. So monies must be pumped into the business as and when the project is ongoing. But the company too might also be incurring other current liabilities such as creditors, payables, and the rest of the expenditure. So the working capital is the lifeblood of the project, without which the project cannot run smoothly despite the huge capital expenditure that the company has incurred. Another one is what is described as terminal. Another one is the terminal terminal flows. Now we will come to the terminal flows and explain it further. But for now, let's go to the operating cash flows. Now, the operating cash flows include advertising costs. So as the business produces the product, it must advertise the product, and the advertisement costs will represent operating cash flows. We also have salaries and wages of workers. workers. This one will represent operating cash flows. This will represent operating. Then heating and lighting. Heating and lighting in the course of the project will represent operating cash flows. The next one will also involve purchase of raw materials. So the cost associated with purchasing of raw material represent operating cash outflows or operating costs. Operating costs that are associated with the project. Okay, so now let's go to the terminal cash flows. Now, terminal means at the end of the project. So this one means the end of the project. What are some cash inflows and outflows that are associated with the project? Now here we can have something like so let's first of all look at the inflows that will be associated with a project when it's at its end. Now the first one here, let's say A, the first one here is sales revenue from the project. No, let me state it well. This is this looks at, let's say, sale of the project. So let's take, for instance, you undertook a project which is for 5 years. Let's say you undertook a project for 5 years. Within the 5 years, you realize that the project has not been well functioning, or it has not met its expectation. Therefore, the management of the company decided that instead of continuing with the project, they will offload the project to a new person who is interested in the project. That is, they will sell the entire project to a new person. Selling the entire project and the proceeds that come from the entire project sale becomes a terminal inflow. The next one is salvage value. Of assets. So at the end of a project, you realize that you bought some plant and machinery for the project. But at the end of the project, you realize that these machines are still functioning well and it's needed by other people who are ready to part money for such machines. Therefore, when those machines have saleable values and are easily, or they can be easily sold in the open market, with people expressing interest in the purchase of such assets, then the amount of monies that will be received from such sales becomes the salvage value of that asset. So that becomes an inflow or terminal inflow. Another inflow or terminal inflow is the recovery of any working capital. The recovery of any working capital. So all the money that you have invested midway into the investment, the money that you invested midway into the investment, at the end of the project, they must all be recovered. And so if the business recovers all the working capital it has invested in the project, that becomes terminal inflow. Now let's look at terminal outflow. Let's look at terminal outflow. One of such terminal outflow is cost of asset demolition. Cost of asset demolition. What does this mean? This means that, let's take for instance, you built some plant for the treatment of wastes as a result of the project being undertaken. And so when the project comes to its end, that plant that you built must be demolished. The cost associated with demolishing such a plant becomes the cost of asset demolition, which represents an outflow. Then you can also have costs of restoring. There's a cost of restoring resources. Example, let's say land. So the project went on, and at the end of the project, let's say you are a mining company, you've mined gold, you've mined diamond, you've mined all kind of minerals found in the land. At the end of the project, the law says that you should restore the land to its natural form. Let's say by planting of trees or by leveling the land so that there wouldn't be any gullies or big holes on the land. If that happens, then the costs associated with such restoration will represent terminal outflows. Then let's say redundancy payment. The last one is redundancy payments. So after the project, let's take for instance that the workers or the human capital that you've used on the project for that period, after the project, they cannot be transferred to another project. So you have to make them redundant, or their services must be ceased. You no longer require their services. Therefore, there must be a severance pay that you give to all these people. That amount of money will represent terminal outflows from the project. So these represent basically the two kinds of cash flows that are associated with a project. We have considered the capital cash flows and the operating cash flows. Capital cash flows represent the initial investment, additional or midway investment, and the terminal flows, while the operating cash flows represent cash flows that come as a result of the decision that you have undertaken. And the typical examples are advertising costs, salaries, and the rest, lighting and heating, and all that we have considered. Then the terminal values, the inflows and outflows, we have also considered. Now let's move on to the investment appraisal methods.